What is a focused fund? A focused fund is a type of mutual fund or investment fund that concentrates its investments in a limited number of stocks or securities, typically between 20 to 30 holdings. The fund manager of a focused fund carefully selects the stocks or securities to include in the portfolio based on a set of investment criteria such as fundamental analysis, market trends, and economic conditions. The goal of a focused fund is to generate high returns by investing in a concentrated portfolio of companies that the fund manager believes will outperform the market. By focusing on a limited number of high-quality stocks, the fund aims to achieve better returns than a more diversified portfolio that may include lower-performing stocks. However, focused funds carry higher risk than more diversified funds because they are more heavily invested in a small number of stocks or securities. If one or more of the holdings perform poorly, it can have a significant impact on the overall performance of the fund. Therefore, investors considering investing in focused funds should carefully evaluate their investment goals, risk tolerance, and investment time horizon before making a decision. An open-ended equity scheme investing in maximum 30 stocks. The scheme needs to mention where it intends to focus, viz., multi-cap, large cap, mid-cap, small cap. Minimum investment in equity and equity-related instruments shall be 65% of total assets. Focused funds are suitable for investors who are looking for high returns and are willing to take on a higher level of risk. The fund is suitable for investors who have a long-term investment horizon and can tolerate the higher level of volatility that comes with investing in a concentrated portfolio. One advantage of a focused fund is that it provides investors with the potential for higher returns, as the fund manager invests in a limited number of high-quality stocks or securities that have the potential to outperform the market. Additionally, focused funds often have lower expense ratios compared to other actively managed funds, as the fund manager has fewer stocks to manage, which can lead to cost savings for investors. However, focused funds also carry higher risk, as the fund is heavily invested in a limited number of stocks or securities. This means that if one or more of the holdings perform poorly, it can have a significant impact on the overall performance of the fund. Therefore, investors should carefully evaluate their investment goals, risk tolerance, and investment time horizon before investing in a focused fund. It's also important to note that focused funds are actively managed, meaning that the fund manager makes investment decisions and adjustments to the portfolio on a regular basis. As such, investors should monitor the fund's performance and the fund manager's investment decisions to ensure that they are aligned with their investment goals and risk tolerance.